What's up everyone? Welcome back to the channel. The market's been a wild ride lately, and with all the noise, it's tough to know where to invest. Today, I'm breaking down 7 trending stocks: Figma, Soligenix, Pop Culture Group, Verifyme, Pineapple Financial, Recon Technology, and a crypto called BankrCoin. We'll look at what they do, their financials, and whether they're worth your attention or just hype. If you enjoy this kind of analysis, hit that like button and subscribe so you don't miss future videos. Let's dive right in. First up is Figma, ticker FIG. This company has been making waves in the design world, and for good reason. Figma isn't public yet, but it's been in the spotlight after Adobe's $20 billion acquisition attempt fell through. That deal would have been one of the biggest in tech, but regulators stepped in, and now Figma remains independent. Figma is a collaborative, web-based design tool. Think Google Docs for designers. It lets teams work together in real time no matter where they are in the world, making the design process faster and more creative. Its SaaS model hooks users with a free tier, then monetizes teams and enterprises with advanced features. This freemium approach has helped Figma grow rapidly, attracting everyone from students to Fortune 500 companies. The platform's real-time collaboration and sticky ecosystem make it hard for companies to switch. Once a team is set up on Figma, moving to another tool is a major hassle, which keeps churn low. Figma's reported annual recurring revenue is over $400 million, and its user base is fiercely loyal. The company's growth rate is impressive, and it's become a must-have tool for modern design teams. Adobe's failed buyout shows just how much of a market leader Figma is. Adobe saw Figma as a threat, not just a compliment, which says a lot about Figma's position in the industry. If Figma IPOs, expect a high valuation, maybe too high for some investors. The hype will be real, and demand could push the price up fast, so caution is warranted. The main risks: a potentially expensive IPO price and rising competition from Canva and AI-powered tools. These rivals are innovating quickly, and the design software space is getting crowded. Still, Figma's network effects and industry standard status are huge advantages. Its integrations and community support make it even harder for competitors to catch up. You can't buy it yet, but it's one of the most exciting private companies out there. Investors and tech insiders are watching closely for any news about a public offering. If it goes public, I'll be watching closely. The IPO could be a major event for the tech sector, and it's likely to attract a lot of attention. The fundamentals are strong, but the price will matter. As with any hot IPO, valuation discipline is key. Don't get swept up in the excitement without looking at the numbers. For now, keep Figma at the top of your IPO watch list. It's a rare blend of growth, loyalty, and innovation in a massive market. It's a wait and see, not a buy, simply because you can't buy it yet. But that could change quickly if an IPO is announced. But if you're interested in design tech, this is the one to watch. Figma is shaping the future of how teams create and collaborate. The failed Adobe deal is a bullish sign for Figma's independence. It shows the company has the strength to stand on its own and keep innovating. If and when it IPOs, read the S1 carefully. Stay tuned for more updates and be ready to act if the fundamentals and price line up. Next up is Soligenix, ticker SNGX. A textbook example of a high-risk, high-reward biotech play that's not for the faint of heart. Soligenix focuses on developing treatments for rare diseases and biodefense threats. While their research is innovative, the company isn't profitable and burns through cash to fund its ambitious R&D projects. The company's value hinges almost entirely on the future success of its drug pipeline, rather than any current revenue streams. Investors are essentially betting on the hope that one of these drugs will make it big. The biotech sector is notoriously volatile. A single clinical trial result can send the stock soaring or crashing overnight, making it a roller coaster for shareholders. Most drugs in clinical trials never actually reach the market, and a failed trial can wipe out years of progress and most of the stock's value in an instant. Even if a drug shows promise, there are still major regulatory hurdles to clear and commercialization challenges to overcome before any profits are realized. To keep the lights on, Soligenix relies heavily on government grants and frequent stock offerings, which can dilute existing shareholders and add more risk. Unless you're a seasoned biotech expert who's done deep research, investing here is closer to gambling than traditional investing. For most people, the risks involved with SNGX far outweigh any potential rewards, especially given the odds stacked against success. The underlying science might be exciting and full of potential, but the odds of a breakthrough are long and the path is filled with obstacles. If you're not prepared for wild price swings and the very real possibility of losing your entire investment, it's best to steer clear. There are far safer and more reliable places to put your money if you're looking for steady growth or income. Only consider SNGX if you truly understand the science, the pipeline, and can stomach the extreme risk and volatility that come with it. For the average investor, this is a clear pass. The risk is sky high, and the reward is anything but certain. Unless you're a true biotech specialist, it's wiser to watch from the sidelines and move on to safer opportunities. Let's talk Pop Culture Group, ticker CPOP, a microcap in China's entertainment scene. They host hip-hop events and run a digital platform targeting Chinese youth. The market sounds huge, but CPOP's financials are weak and revenue is inconsistent. The stock is extremely volatile, often spiking or crashing on little news, classic pump-and-dump territory. Investing in Chinese stocks brings extra risks, regulatory crackdowns, lack of transparency, and complex corporate structures. CPOP uses a VE structure, so you don't actually own the underlying business. Competition is fierce, with giants like Tencent and Alibaba dominating. CPOP's small size makes it hard to compete or scale profitably. The wild price swings are a major red flag. This isn't a long-term investment, it's speculation at best. The risks of market manipulation and regulatory uncertainty are just too high. Chasing hype here is a recipe for losses. For me, CPOP is a hard avoid. Too many red flags, not enough substance. If you're tempted by the volatility, remember, you're more likely to get burned. There are better ways to play the entertainment sector. Skip this one. Next up is Verifyme, ticker VRME, a company that's carving out a niche in the anti-counterfeiting technology space for brands and manufacturers worldwide. Their mission is to help companies protect their products and reputations from the growing threat of fakes and fraud. Their solutions are pretty innovative, ranging from invisible inks and secure QR codes to advanced supply chain tracking, addressing a real, rapidly growing problem for global brands and consumers alike. The market opportunity is massive, but Verifyme is still a small player, up against industry giants like 3M and Avery Dennison, who have far more resources and established client bases. They've managed to secure some promising partnerships, especially in fast-growing sectors like cannabis and apparel, but consistent profitability remains elusive for now. Revenue is ticking upward, but it's still coming off a small base, and the company continues to post significant losses quarter after quarter. Like many early-stage tech firms, they may need to raise more capital to fund growth, which could mean dilution for current shareholders. The big question is whether they can scale quickly enough and land major clients before the larger, better-funded competitors squeeze them out of the market. The sales cycle for their solutions is long, and adoption by big brands tends to be slow, which adds to the challenge. It's definitely a speculative play, more grounded than some ultra-high-risk stocks like CPOP, but still not for the faint of heart. If management can execute and finally show a clear path to profitability, there's real upside potential here for patient investors. For now, though, it's best viewed as a watch-list candidate rather than a buy. Only consider investing if you have a high-risk tolerance and a strong belief in the management's vision and ability to execute. It's wise to wait for clearer signs of business acceleration and evidence that they can win larger contracts. The underlying idea is solid, but as always, execution is everything in this space. Don't get swept up by the story alone or the promise of future growth. Keep a close eye on their progress and watch for any signs of momentum. For now, approach with cautious optimism. There's potential, but it's not a buy just yet. Pineapple Financial, ticker PAPL, is a Canadian fintech aiming to modernize mortgage brokering. They offer tech and branding to mortgage agents, taking a cut of commissions. The concept is fresh, but the mortgage industry is highly cyclical and sensitive to interest rates. Rising rates have cooled the housing market, making growth tough for Pineapple. Their revenue is volatile and they're still trying to achieve scale. Competing with big banks and established networks is a major challenge. Key metrics: broker network growth and mortgage volume per broker. The stock trades like a penny stock, highly volatile and risky. Until the housing market recovers and Pineapple shows stable profitability, it's too risky. Interesting idea, but not investable right now. Avoid for now. Revisit if the market turns and the company matures. Branding is clever, but fundamentals matter more. Wait and watch. Recon Technology, ticker RCON, is a Chinese microcap serving state-owned oil giants. They provide automation and equipment to companies like Sinopec and PetroChina. The oil sector is huge, but Recon's financials are inconsistent and profitability is elusive. Heavy reliance on a few big clients is risky. Losing one could devastate revenue. Investing in Chinese stocks adds layers of risk, regulatory crackdowns, lack of transparency, and VIE structures. The stock is extremely volatile, often moving on speculation rather than fundamentals. The global shift to renewables is a long-term headwind. Too many risks for the average investor: industry, client concentration, and geopolitical uncertainty. If you want energy exposure, look to larger, more transparent companies. RCON is a firm to avoid. The risks far outweigh any potential reward, not worth the gamble. Move on. Last up is BankrCoin, ticker BNKR, a new DeFi crypto aiming to bridge banking and crypto. The pitch: decentralized financial services, staking and governance, all without a traditional bank. Sounds ambitious, but the risks are massive. Most new altcoins fail or turn out to be scams. Key red flags: anonymous teams, unclear tokenomics, and unproven technology. Even legit projects face smart contract hacks and vaporware risks. Unless you're a blockchain expert and have vetted everything, this is pure speculation. The odds of picking the next big crypto are tiny. The odds of losing everything are high. For almost everyone, stick to established coins like Bitcoin or Ethereum. BankrCoin is not an investment. It's a gamble. Don't chase hype in the crypto Wild West. If you want crypto exposure, go with the leaders. Stay safe. To wrap up, most of these trending stocks and cryptos are high-risk plays best avoided by long-term investors. Figma is a standout to watch for a future IPO, and Verifyme is interesting but speculative. The rest, SNGX, CPOP, PAPL, RCON, and BankrCoin, carry extreme risks, from clinical failures to regulatory and scam concerns. Chasing hype is a fast way to lose money. Always do your own research and never invest more than you can afford to lose. Let me know your thoughts in the comments, and don't forget to like and subscribe for more breakdowns. See you in the next one.